Hello, students. Welcome to the concluding part of our last lesson, which was on business units and other concepts, related concepts. My name is Tirimin Olalegbenshola, and this is Igota Virtual Learning Platform. And we'll be concluding the remaining section in this video. Let us start with the lesson objective. By the end of this lesson, you will understand the sources of funds for each of the business units we'll be discussing about. Number two, we'll also be discussing other aspects of the business units which we're not able to cover in the last lesson. And number three, you will understand the basic related concepts such as amalgamation, cartel, and others. Let's start with the source of capital for sole proprietor. Now, we said that the sole proprietor is a one-man business and it doesn't have anybody that is working with. That means that every risk and every other challenges that a sole proprietor face, he or she face alone. So, what are the sources of capital of a sole proprietor? Now, a sole proprietor can obtain its capital from the following sources. We have personal savings, we have loan from friends, trade credits, loan and overdraft from banks, grant and loan from government. Moving on, let us talk about the source of capital for partnership. Partnership, they have personal contribution for partners. That means that the partners can jointly agree to contribute their money in either equally or pro rata as major source of capital. Pro rata means they ratio the shares of the amount whereby each members of the partners will contribute to the business. We also have trade credits, that is money can be obtained from middlemen in advance in order to facilitate production of goods. There's also undistributed profits that are retained profits that can be pumped back into the business to aid its expansion. That means profits that are remaining from the business that they have done in the earlier months or the earlier years, looking at the particular time and period the particular business was done, whereby they were able to earn their profits. And we also have admission of new partners. Upon the admission of new partners, more capital will be expected to be brought into the business, because for every new partners that are coming into the partnership business, he or she is expected to bring in his own resources, his own money, his own experts and experience into the business in order to improve the pattern at which the business will grow. Let's talk about the source of funds or capital available for private limited company. If you can remember earlier on in the last lesson, I said we have two types of limited liabilities company. We have the private limited liabilities company and we have the public limited liabilities company, which I will further explain as the lesson proceeds. So let us talk about the source of funds for private limited company. Talking about limited source of funds for limited liabilities company, for private limited liabilities company, we have loans and overdraft from banks. Now, loans and overdrafts can be obtained from commercial or development banks. We also have shares raised by shareholders. Shares are usually raised by shareholders that are the owners, which form the capital base of the company. That means the initial money that are used to start the business of the private limited company. We have equipment leasing. Equipment can be leased out by companies for money. That means the companies can lease out their machineries for other business to use, whereby they can make money, or that means they are renting out their equipment for other people to use their equipment and they can make money through it. We have retained profits, that is the profit made by the company can be set aside or reinvestment. There's also trade credits. Raw materials can be purchased by the company on credits. And we also have hire purchase. Facilities can be granted to the company to buy and pay by instrumentally. Now, let us talk about the second part of the limited liability company, that is public liability company. Now, what does that mean? Now, source of funds for public limited liability company includes loan and overdraft. We have discussed that about earlier on. We have sales of shares. Now, sales of shares, public company are a joint stock company, can also raise capital by issuing shares for public subscription. We also have the sales of debentures. These are long-term loans obtained from general public at a fixed interest. We also have bill of exchange. This is a document duly signed by the debtors bank to the creditor, and the creditor cashes the money with some discounts. We also have equipment leasing, which I've explained earlier on in the last explanation on private limited liability company. We also have trade credits. We also have hire purchase, all under source of fund for public liability company, which is also known as joint stock. Let us move on to the next on our list, which is to discuss and analyze the various aspects of this business unit that we were not able to cover in the last video. So we are going to be talking about the reasons for the continuous existence of small scale business. That is, why is it important that entrepreneur is important in our environment? The first reason we are going to be talking about is small capital requirement. The small scale business requires just a small capital to set up, and the next one is easy to establish. Yes, it's very easy to establish. The small scale business units are easy to set up or establish, since there's no formality or necessary legal registration to be made that are so stressful. We have the provision of incentive for hard work. As an entrepreneur, there's always an incentive for the hard work an entrepreneur puts in, since he's the owner. So the ownership instills pride and drives the entrepreneur for success. They also enjoy customers' loyalty. Small scale business units always enjoys customers' loyalty and good relationship, which ensure continued patronage. Ability to change policies. The policies of a small scale business can be easily be changed and quickly to meet up with the changing needs of customers. It has a lower risk. The small scale business are usually at low level of risk. The other reasons are low overhead costs. They meet the special need of customers, availability of goods in remote areas, and they serve as need for larger firms. Let's proceed by looking at the types of partners which is under partnership. The first one we are going to be looking at is limited partners. What does that mean? A limited partner is the one who has agreed to contribute a certain sum of money to a partnership business and is prevented by law from taking any active part in the management and administration of the business. He is liable for debts and obligation of the partnership only up to the amount of capital he has contributed to the business. The second one we are looking at here is general partnership. What does that mean? A general partner has a full power of participating in the conduct and management of the partnership business. He is entitled to take full share in the management of the firm. This kind of partners is liable to the full extent of his estate for the partnership debts. Number 3 on our list is active partner. An active partner takes active part in the management and administration of a partnership business. It contributes to the financing and formation of the business, takes active role in the day-to-day running of the entire enterprise, and is being paid a certain amount of money as salary. Last but not the least on the types of partners is nominal or quasi-quota partner. A nominal partner contributes only his name to the formation of the business. He neither contributes capital nor take part in the management of the firm. A nominal partner may be distinguished personalities within the society, as his name must surely increase the reputation and the possibility of goodwill of the partnership business. Now, let us move on to talk about the rights of partners in the partnership business. So, we have various forms, but because of time, I will try as much as possible to summarize. So the first one we are looking at is right to participate in management, right to share profits, right to inspect books of accounts, right to indemnify, right to interest on capital. The partners are entitled to share from the profit of the business. A partner making advance beyond the amount of capital which has agreed to subscribe is entitled to interest of 5%. A partner has the right to act as agent of the business. Every general partner can take part in the management of the partnership. Every partner must have access to the partnership books of accounts. They must be indemnified by the firm in respect of payment made and personal liability incurred by them in the conduct of the business. Do you know that every type of business must have a kind of a document? So we are going to talk about the one of partnership, which is deed of partnership. So what exactly is deed of partnership? It is accordingly usual for people entering into partnership to express their intention in a partnership agreement known as deed of partnership. So deed of partnership may be defined as agreement, rules and regulations guiding the members of a partnership. Now, it is time for us to talk about the meaning and purpose of various business basic concepts. We are going to be starting with amalgamations. Now, what is the meaning of amalgamation? That is the combination of two or more companies into a new entity. Actually, this usually happens when a particular company has a problem and want to merge, or they have an agreement with another company so that they can pull their resources together to form a single company. An example, we have the Diamond Bank having an agreement with Access Bank, and now we have Access Bank. But if you want to make a transfer, you see something like Access Diamond Bank, or basically Access Bank. So the purpose of this is that it increase market shares, achieve economic of scale, and they will be able to diversify product offering. That is the kind of product they offer. They'll be able to diversify into various sections of the market in the particular country or any other part of the world where they have other branches. The third one, which we are going to talk about, is trust. Now, what is trust? Trust is a group of companies transferring their stocks to a central management. Now, the purpose for this is they want a central control, they want to reduce competitions, they want to increase efficiency in operation. Now, a group of companies that are transferring their stocks, now we say that stocks are kind of shares being bought by shareholders in order to finance the operation of a particular company. So a process whereby a group of companies transferring all their stocks to a particular management, to one company, is probably they want to reduce and they want to increase their efficiency in operation. Let's talk about holding companies as subsidiaries. Holding companies and subsidiaries means, let's talk about holding company for example now. Holding company, that means they own other company outstanding stock, while subsidiary is a company controlled by a holding company. Like for example now, let's take Sony. Now Sony is a company that deals in entertainment, and they also own other companies like Columbia Pictures. Yeah, there's an example of a subsidiary. Now the purpose for this is to diversify risk, tax benefits, and maintain control while limiting liability. Let's talk about consortium and cartel. Consortium are temporary alliance of companies for a specific project. That means two companies come together to join their resources together just to create a source of bond to make sure that a particular project which they are embarking on becomes successful. Now, the purpose of a consortium is to share resources and expertise, to spread risk on large projects. And let us move to cartel. Cartel can be defined as a group of firms or producers whose objective is to limit competition by centrally fixing prices or quantities, or both, as a means of maximizing their profits. It is an association which has monopoly influence on the market by artificially restricting output, competition, and rising price. Examples of organization of petroleum exporting countries, that is OPEC. Next, let us talk about dissolution and liquidation of companies or partnership. Now, what does that mean? That is the process of bringing a business to an end and distributing its assets. What are the process? The decision to dissolve can be voluntary or involuntary. Appointment of a liquidator, realization of assets, payment of debts, distribution of remaining assets to shareholders or partners. Reasons for dissolution, probably it can be financial difficulties, accomplishment of purpose, legal issue, or internal conflict. So let me explain it all over again. Now, when I talk about dissolution, we are talking about partnership, or when we talk about two companies coming together to kind of form a bond to complete a particular project. Now, Probably the project has been concluded successfully, and that brings them to the end of a contract. So it can be based on the contract basis that the business is done and everybody has to go his or her ways. Or probably a partnership, 2 or 20 people are no more interested in the kind of business they are doing again, so everybody just wants to go on his or her own way. Now let us practice with some past WAEC questions. I'll present each question and I want you to pause the video and try to answer it before we discuss the solution. Question number 1: which of the following is a disadvantage of a partnership? This is coming from year 2020. A, shared responsibility. B, unlimited liability. C, shared capital. And D, shared experts. Let's take a look and what's our answer. The correct answer is option B, unlimited liability. Let me explain. Shared responsibility, which is option A, is generally considered as an advantage of partnership. Option B, which is unlimited liability, is a significant disadvantage as partners are personally responsible for the business debt. Option C, which is share capital, is typically seen as an advantage, allowing for more resources, while option D, shared expertise, is usually considered a benefit of partnership. Question number 2, which is coming from year 2017, which of the following purpose of a consortium? What is the primary purpose of a consortium? This is coming from year 2017. Option A, to monopolize the market. Option B, to collaborate on specific projects. Option C, to fix prices in an industry. And option D, to acquire smaller companies. The correct answer is B, to collaborate on specific projects. Justification, let me explain. Option A, which is monopolizing the market, is not the primary purpose of a consortium and may be illegal. Option B, which is consortium, are formed specifically to collaborate on large projects, sharing resources and risk. Option C, which is fixing prices, is associated with cartel, not consortium, and is often illegal. Option D, which is acquiring smaller companies, is not the main purpose of forming a consortium. Question number 3, which of the following best describe a cartel? This is coming from year 2021. Option A group of companies working together on a project. Option B, an agreement between competing firms to control prices. Option C, a company that owns other companies. And option D, a merger between 2 large corporations. Was our answer. The correct answer is option B, an agreement between competing firms to control prices. Let me explain. Option A, this describes a consortium, not a cartel. Option B, cartels are indeed agreements between competitors to control prices or limit competition. Option C, this describes a holding company, not a cartel. While option D, this is a definition of a merger, not a cartel. In summary, we have been able to cover the major basic concepts in the business unit, the rights of a partner, the deeds of partnership, the other main types of business unit that we're not able to cover, and we're able to analyze some particular aspects deeply. We have covered various types of business units, including sole proprietorship, partnership, limited liability, corporations, and corporate societies. We discussed the formation characteristics, advantages, and disadvantages of each. We have explored sources of capital for different business types. We define and explain concepts like amalgamation, merger, acquisition, trust, holding companies, and cartels. And finally, we look at the process and reasons for business dissolution and liquidation. Understanding this concept is crucial in the business world. For example, knowing the different business types can help entrepreneurs like you and I choose the best structure for their new ventures. Understanding mergers and acquisition can help you make sense of major businesses news and market changes. I encourage you to review these concepts and practice with more past questions. The more you engage with these ideas, the better prepared you become for your WAEC exams and future business studies. Thank you for your attention today. If you have any questions or feedback for further clarification, don't hesitate to reach out. Keep studying and I wish you best of luck. My name still remains Olawale Benishola. I am still your commerce teacher and this is Igota Virtual Learning signing out.